Bills of exchange. Let it be supposed that there are 10 shoe manufacturers in Lynn, who sell their shoes to 10 shopkeepers in Boston. Let it be supposed, also, that there are 10 wholesale grocers in Boston who furnish goods to 10 retail grocers in Lynn. If the value of the shoes equals the value of the groceries, the 10 retail grocers in Lynn would have no occasion to send money to Boston to pay their indebtedness to the wholesale grocers. Neither would the 10 shopkeepers in Boston have occasion to send money to Lynn to discharge their debt to the 10 shoe manufacturers. For the Lynn retail grocers might pay the money to the Lynn shoe manufacturers. These shoe manufacturers writing to the Boston shopkeepers, who are their debtors, requesting them to pay the Boston wholesale grocers, who are the creditors of the Lynn retail grocers. It is very possible that the transactions of all these persons with each other might be settled in this way without the transmission of any money either from Boston to Lynn, or from Lynn to Boston. The transfer of debts in the process here indicated gives rise to what are called, in mercantile language, drafts, or bills of exchange. Though regular bills of exchange are seldom drawn in this country, except against foreign account. A bill of exchange reads generally somewhat as follows: to Mr. E.F. days after sight, on this, my first bill of exchange 2nd and 3rd of the same date and 10 are not paid, paid to A, B, without further advice from me. Dollars, value received, and charge the same to account of your obedient servant, C.D. This form evidently implies that the bill is made out in triplicates. The bill must also, of course, be dated. A draft is a bill of exchange drawn up with the omission of some of the solemnity and particularity of the regular bill. Bills of exchange are useful not only for the payment of debts at distant places without transportation of the precious metals, but also as a means by which a debt due from one person may be made available for obtaining credit from another. It is usual in every trade to give a certain length of credit for goods bought, 90 days, 6 months, 8 months, or a longer time, as may be determined by the convenience of the parties, or by the custom of the particular trade and place. If a man has sold goods to another on 6 months' credit, he may draw a bill upon his debtor, payable in 6 months, get his bill discounted at the bank and thus qualify himself to purchase such things as he may require in his business, without waiting for the 6 months to expire. But bills of exchange do more than this. They not only obviate, upon occasions, the necessity for ready money. They not only enable a man to command ready money before the debts due to him arrive at maturity. They often actually take place and perform the functions of money itself. 5. The circulation of mutual money petition for a general mutual banking law to the Honorable the Senate and House of Representatives of the Commonwealth of Massachusetts. This prayer of your petitioners humbly showeth that the farmers, mechanics and other actual producers, whose names are hereunto subscribed, believe the present organization of the currency to be unjust and oppressive. They, therefore, respectfully request your honorable body to republicanize gold, silver and bank bills, by the enactment of a general mutual banking law. A law, embracing the following provisions, would be eminently satisfactory to your petitioners. 1. The inhabitants or any portion of the inhabitants, of any town or city in the Commonwealth, may organize themselves into a mutual banking company. 2. Any person may become a member of the mutual banking company of any particular town, by pledging real estate situated in that town, or in its immediate neighborhood, to the mutual bank of that town. 3. The mutual bank of any town may issue paper money to circulate as currency among persons willing to employ it as such. 4. Every member of a mutual banking company shall bind himself, and be bound, in due legal form, on admission, to receive in payment of debts, at par, and from all persons, the bills issued, and to be issued, by the particular mutual bank to which he may belong. But no member shall be obliged to receive, or have in possession, bills of said mutual bank to an amount exceeding the whole value of the property pledged by him. 5. Any member may borrow the paper money of the bank to which he belongs, on his own note running to maturity without endorsement, to an amount not to exceed 1/2 of the value of the property pledged by him. 6. The rate of interest at which said money shall be loaned by the bank, shall be determined by, and shall, if possible, just meet and cover the bare expenses of the institution. 7. No money shall be loaned by the bank to persons who do not become members of the company by pledging real estate to the bank. 8. Any member, by paying his debts to the mutual bank to which he belongs, may have his property released from pledge, and be himself released from all obligations to said mutual bank, and to holders of the mutual bank money, as such. 9. No mutual bank shall receive other than mutual bank paper money in payment of debts due to it, except at a discount of 1/2 of 1%. 10. The mutual banks of the several counties in the Commonwealth shall be authorized to enter into such arrangements with each other as shall enable them to receive each other's bills in payments of debts. So that, for example, a Fitchburg man may pay his debts to the Bar Bank in Oxford money, or in such other Worcester County money as may suit his convenience. Remarks: Let A, B, G, D and E take a mortgage upon real estate owned by F, to cover a value of, say, $600. In consideration of which mortgage, let A, B, C, D and E, who are timber dealers, hardware merchants, carpenters, masons, painters, etc., furnish planks, boards, shingles, nails, hinges, leaks, carpenters and masons' labor, etc., to the value of $600, to E, who is building a house. Let the mortgage have 6 months to run. A, B, C, D and E are perfectly safe. For either F pays at the end of the 6 months, and then the whole transaction is closed. Or F does not pay, and then they sell the real estate mortgaged by him, which is worth much more than $600, and pay themselves, thus closing the transaction. This transaction, generalized, gives the mutual bank, and furnishes a currency based upon products and services, entirely independent of hard money, or paper based on hard money. For A, B, C, D and E may give to F, instead of boards, nails, shingles, etc., 600 certificates of his mortgage, said certificates being receivable by them for services and products, each one in lieu of a silver dollar. Each certificate being, therefore, in all purchases from them, equivalent to a $1 bill. If A, B, C, D and E agree to receive these certificates, each one in lieu of a silver dollar, for the redemption of the mortgage. If, moreover, they agree to receive them, each one in lieu of a silver dollar, from whomsoever it may be, in all payments, then A, B, C, D and E are a banking company that issues mutual money. And as they never issue money except upon a mortgage of property of double the value of the money issued, their transactions are always absolutely safe, and their money is always absolutely good. Any community that embraces members of all trades and professions may totally abolish the use of hard money, and of paper based on hard money, substituting mutual money in its stead. And they may always substitute mutual money in the stead of hard money and bank bills, to the precise extent of their ability to live within themselves on their own resources.